But what do I think is happening with the Bitcoin price? Liquidity's drying up. TGA refill. I think there's a large part of the U.S. economy that is very illiquid. Capital is scarce right now. But what do I think is going to happen? I continue to believe very fundamentally that the U.S. government and the Federal Reserve are acting in a way of survival. They are on their deathbed, and there are a few ways out. Nuclear war, that's uninvestable. We're all gone. Or the exit valve is the U.S. dollar.
For decades, the U.S. economy has been living on borrowed time, propped up by unsustainable debt, reckless spending, and a Federal Reserve trapped in its own policies. What we're seeing today isn't normal market turbulence. It's the last stage of a system clinging to survival. Inflation, debt spirals, and liquidity shortages aren't just buzzwords. They're symptoms of an empire stretched to its breaking point. And here's the truth most people don't want to hear. Inflation isn't just a number on a chart. It's a hidden tax. It steals from your savings, from your wages, from the future you dream of for your family. Every dollar printed, every bond sold to patch holes in the treasury, is a transfer of wealth away from ordinary Americans and into the hands of those who built the very crisis they now claim to be fixing. Meanwhile, crypto investors have been left wondering why this cycle feels different. Where's the explosive rally? Where's the upside we've all been waiting for? The reality is that capital is being drained to fund government deficits, leaving liquidity scarce across risk assets. But as Strike CEO Jack Mallers explains in his latest video podcast, this is exactly what sets the stage for Bitcoin to shine. Because, unlike the S&P 500, Bitcoin isn't just another passive asset propped up by money supply growth. It's the escape valve, the mirror that reflects the decay of fiat. Today, we're diving deep into Jack Mallers' latest analysis, where he argues that the Fed's moves aren't about jobs or inflation, but pure survival. What does that mean for markets? And more importantly, for Bitcoin? Stay with us, hit that like button, subscribe if you're new, and let's break down why this era of survival economics may become Bitcoin's most powerful catalyst yet. Thanks for tuning in, and enjoy the video.
The United States is not cutting rates for jobs or for inflation. They are cutting rates to keep the U.S. Treasury alive, to keep the U.S. government alive, to keep the U.S. empire alive. The cost of that survival is all of you. I'm going to say that again. The cost of their survival is you listening to this show. You, your life, the things you can acquire, the family you want to have, the house you dream of living in. That is the sacrifice and the expense of keeping this empire chugging along. And so think through the framing of this rant as about survival, understanding the task at hand by the powers that be and who they are shortcutting to get where they need to go. First chapter for us, I call the liquidity machine. So going into the show, everyone's like, Jack. I thought Bitcoin only goes up. Bitcoin's down 2.5%, which, by the way, come on, chill out. 2.5% is nothing in the grand scheme of things. But yes, Bitcoin took a dip. And I wanted to focus on, I actually think that this dip is very healthy. I'm very excited by this dip. I think this dip is good news. And I want to explain why and just the general trend of what's happening if we zoom out. So this tweet from Arthur Hayes, TGA refill almost done. Target is 850 billion. With this liquidity drain complete, up only can resume. Okay, let's understand what's going on here. So the TGA, that stands for the Treasury General's account. So what Arthur is saying is the Treasury General's account refill is almost done. Think of the Treasury General's account like what it sounds like. It's the it's the checking account of the U.S. government. The U.S. government's checking account sometimes needs to be refilled. How do they refill their checking account? How do they refill their bucket of cash? Well, they sell bonds, which is a way of borrowing money from the market. And so when the Treasury does that, what Arthur is claiming is they're draining liquidity out of the system because a lot of the capital that is in Bitcoin, that is in assets, that is floating around in the economy, then goes to finance the government by buying bonds. Does that make sense? And so every so often, the United States government needs to refill their checking account. And he ends his tweet by saying, once that's done, we can continue to go higher. What does he mean by that? He means we're going to continue to go higher because once the Treasury has their checking account full, they go and spend that money into the real economy. One of the biggest spenders in the economy is the US government itself. And that capital finds its way into Bitcoin, into real estate, into the stock market, into gold, into the economy. And so the Treasury general account is being refilled. That will suck liquidity out of the system. And I think why this excites me so much is Bitcoin continues to be the best expression of fiat liquidity, the best pulse, the best index, the best heartbeat as to how healthy the system is, where the liquidity is, all the way to the Treasury literally refilling its checking account, its money bucket. Just so you guys know, I think that there are serious liquidity issues within the market. We are living in two economies, as I've been saying on this show. There is the ultra wealthy, and then there is everybody else. There are scarce, desirable asset holders, and then there is everybody else. And we'll get into that in detail later in the episode. But the everybody else continues to struggle. The Treasury is draining liquidity right now. And I think Bitcoin is reacting to that. And as a Bitcoin holder, that's what you want. You do not want Bitcoin to be like the S&P 500, to be collecting a bunch of passive flows that backs the Treasury market with its bullshit 10% up every single year that's basically more or less reflecting the increase in M2 money supply. You want Bitcoin to be the escape valve, the exit door, the pure reflection of the devil in the mirror. You understand? So let's take a look and deep dive a little bit into the high level. The high level, zoom out and take a look at the bigger picture. So I pulled up this tweet last episode. I wanted to resurface it. So it reads, in the month of August, the U.S. government collected $344 billion. Now that is from tariffs. So that is income the United States is generating, revenue the United States is generating, new revenue from this tariff program. Good for them. Just one problem. They spent $689 billion. So that is a $345 billion with a B, $billion deficit in 1 month. If you were to annualize that, take that $345 billion, you multiply it by 12, you're well over, $3 trillion of deficit spending in a year. Incredibly unsustainable. Why do I want to resurface this? Well, according to the Wall Street Journal, in September 2025, U.S. individual income tax payments for fiscal year have increased by 12% year over year, meaning the U.S. growth in the income that they take from all of us in taxes, the theft that they take from us via taxes. I just had a massive IRS payment. So the theft, the property theft that they are taking from us in the form of taxes grew 12% year over year. Another interesting stat is the U.S. money supply has grown about 5% year over year. So the money supply is up 5%. Tax receipts are up 12%. How the hell is the deficit higher? Guys, that would be the equivalent if you got a 12% raise, but your credit card bill went up anyway. If you're bringing in more income, if you are printing more money, the deficit is supposed to come down. Despite 12% year over year tax receipts, despite 5% year over year U.S. money growth, despite tariffs, which brought in over $300 billion in a month, our deficits grew. Our deficits grew.
Mallers begins by reframing the current crisis. The United States isn't cutting rates to help workers or tame inflation. It's cutting rates to keep the Treasury alive. That survival comes at a cost, and the cost is borne by everyday people. Your lifestyle, your purchasing power, even your dreams for the future, all sacrificed to keep the machine running. And yet, this liquidity drain, painful as it feels, is exactly why Bitcoin's dip is a good thing. It shows Bitcoin is reacting as a pure signal of fiat weakness, not becoming just another Wall Street instrument. From there, Mallers takes us into the second chapter of his rant, a brutal but honest look at America's debt spiral. By using a chart from Luke Gromen, he shows just how unsustainable the federal balance sheet has become. Even record-breaking inflation, zero interest rates, and a booming stock market during COVID barely moved the needle on U.S. debt to GDP. If that extraordinary set of conditions only created a microscopic dent, what chance do we have now under normal circumstances? And what happens if rates aren't cut? That's where Mallers makes his case.
This chart is from Luke Gromen. Okay, this is the blue line is gross federal debt as a percentage of GDP. Okay, you can see from the world wars until when we divorced from the gold standard, you can see this number go down. Now, if you look at the far right, Luke circles this little hitch, this little tiny dip, this little teeny tiny dip, because we want to get this down as a country. And look at his note here. It reads, note that this little drop in debt GDP from 2020 to 2022, so COVID, required 8% CPI, so record-breaking levels of inflation, 0% interest rates, and it aided by massive recovery from COVID and massive year-over-year SPX increase, so stock market up. So just to make that little tiny dent, that little tiny blip, that if that wasn't circled and I didn't highlight it to you guys wouldn't have even noticed. Just that little blip was record-breaking inflation, 0% interest rates, asset inflation through the roof, that then required us to have the fastest rate hike in the history of the United States that caused all of our banks to fail. And I'm supposed to sit here and believe that we're going to drive this blue line down without real rates negative, without financial repression? Are you crazy? And the point, again, I've shown this chart a million times, guys. The point is this. What do you cut? Listen, we as a government are spending more than we bring in. As the world reserve currency issuer, our major export is the dollar itself. So we have to export more dollars than we import dollars. Think of it that way. Our job as the world reserve currency issuer is to give the world more dollars than we take in from them. I could tell the US government how to solve their problem and it'd take 5 seconds. Don't be the world reserve currency. Now, if you want to be the world reserve currency, if you want to prolong this empire, if you want to keep the show going at the expense of your people, well, then we have to cut spending somewhere. Let's look at this visual. Where do you want to cut? Health and Human Services? Social Security? Defense spending? There is one place where you can cut and you can kick the can down the road. It is the Treasury. It is the interest expense on our debt. So you have to understand, we are not cutting rates to stimulate the economy. We are not cutting rates in a reaction to jobs. We are cutting rates not as a supplement to the economy. We are cutting rates as a lifeline to the U.S. Treasury, to the U.S. government. If we do not cut rates and we do not bring this Treasury expense down, we will default. We will go into a debt spiral. It is over. Game over. GG's. Good game. Sayonara. See you later. So you guys have to understand this, because the mainstream media, the traditional bondholders that have been holding bonds for the last 40 years, they're writing this off as a political fiasco, that Trump is an egomaniac and he's in it for himself and he wants to control the Fed because he's into his own ego. And all of that may or may not be true. But I'm telling you right now, the economic reality, again, money is your time and energy in abstracted form. Money obeys the laws of physics, of Mother Nature, of the real universe. Money carries no opinion. A real money, a hard money, is truthful. I'm telling you the truthful economic reality grounded in physics. We have to cut interest rates or else the US government fails. That is why they're doing what they're doing. You have to understand that. And then we will understand the implications of that, what that means, who that's going to burden and who that's going to continue to kill. But what do I think is happening with the Bitcoin price? Liquidity is drying up. TGA refill. I think there's a large part of the US economy that is very illiquid. Capital is scarce right now. But what do I think is going to happen? I continue to believe very fundamentally that the US government and the Federal Reserve are acting in a way of survival. They are on their deathbed, and there are a few ways out. Nuclear war, that's uninvestable. We're all gone. Or the exit valve is the US dollar, is inflation, is a tremendous wealth gap that ensues a ton of violence that we've been seeing recently.
The conclusion is inescapable. The United States can't grow its way out of this debt problem. It can't inflate it away without destroying its citizens' purchasing power, and it can't cut spending without risking political chaos. That leaves one option: financial repression. Rates must be cut, not to stimulate the economy, but to keep the government solvent. This isn't a policy choice, it's a necessity for survival. What does that mean for you, the investor? It means the Fed's so-called pivot is not a bullish signal for equities or a sign of strength. It's a distress flare. It tells us the system is too fragile to handle higher rates. And when money is forced back into circulation, when the Treasury starts spending its refilled account, liquidity flows back into the economy. Historically, that's when Bitcoin and other sound money assets outperform, because they serve as the exit door for anyone who sees the writing on the wall. We're already seeing the cracks. Tax receipts are up, tariffs are up, money supply is up, yet deficits are exploding higher. That's like getting a raise at work, but still sinking deeper into credit card debt. It's unsustainable, and eventually, the markets will recognize that the dollar itself is the release valve. For Bitcoin, that recognition is everything. It's why every dip is an opportunity, and every wave of liquidity mismanagement by the Fed brings us closer to the breakout. This brings us back to the Bitcoin and crypto market. After Monday's $1.5 billion crypto derivatives wipeout, Bitcoin is still struggling to regain momentum. The world's largest cryptocurrency traded at $112,800, near its lowest level in 2 weeks, extending losses after dropping more than 3% below $112,000 on Monday. According to CoinGlass, over 400,000 traders saw leveraged bets wiped out, with Ether falling as much as 9%, and altcoins like Dogecoin suffering steep losses. Thin liquidity and overextended positioning amplified the sell-off, while traders now brace for one of the largest option expiries ever. Over $23 billion in Bitcoin and Ether contracts set to roll off on Friday, according to Deribit. Add to that the uncertainty around Federal Reserve Chair Jerome Powell's upcoming remarks, and you've got a market that's tense, volatile, and waiting for direction. And yet, seasoned macro investors are unfazed. Raoul Pal summed it up best in a post that has already racked up over 7,000 likes, which reads, "Same thing happens all the time. The crypto market is focused on a big breakout, gets levered long ahead of it, it fails at first attempt, so everyone gets liquidated. Only then does the actual breakout occur, leaving everyone sidelined." When you combine Pal's observation with Jack Mallers' framing, the takeaway is clear. These wipeouts aren't signs of weakness. They're signs of stress in a system where liquidity is being drained at the top, while Bitcoin continues to act as the release valve. The Fed may be cutting rates to save the Treasury, but in the process, they're setting up the conditions for capital to eventually flow back into Bitcoin. And when that happens, the sidelined money, the capital forced out by leverage washouts, will be chasing higher prices. And drop a comment with your thoughts on where you see Bitcoin heading next. If you found Jack Mallers' analysis as powerful as we did, make sure to hit that like button, subscribe for more breakdowns like this. Until next time, stay informed, stay prepared, and stay bullish. Thanks for watching.